Now, Microsoft also came out with earnings today, surprising investors before the bell and surprising investors with better than expected profits. But the stock has almost doubled from its low this year, hitting a 52-week high in today's session. So you got to ask, is it overvalued? Or is Windows 7 a chance for the company to grow? For the answer, let's ask a shareholder and value investor, Matt McLennan, head of global value for First Eagle Fund. So, Matt, let's talk about Microsoft. Investors certainly like what they had to heard, but what they got from Microsoft. But they've had a great run. I mean, is there still any value there?
Well, at First Eagle, when we start out looking at investment, we're always focused on the downside and what can go wrong. In the case of Microsoft, you started from a point of very low expectations. When the stock was trading in the mid-teens, you were trading at a single-digit multiple of earnings. This is a long way from the tech stocks of yesteryear in the late 1990s when you were trading at over 100 times earnings. So you started from a low valuation. What the company has shown in its current earnings release is that they have a lot of latency in their cost structure. They managed to attack the cost line quite aggressively, and that's positioned them well for future profit growth as the new product cycle begins in Windows 7 and some of their other key business areas.
Let me ask you, very successful value investor Don Yackman says he likes to look at how well a management uses the cash it throws off from its core businesses, and Microsoft obviously generates a ton of cash. Are you impressed with the way management uses that money?
Well, I think if you look at Microsoft as a whole, there has been some criticism through time that they've funded a number of marginal business initiatives. But I think if you look at the long-term track record of the company, they have produced a lot of value for shareholders over the very long term. Most recently, the company has reinitiated its stock repurchase program at a discount to our sense of intrinsic value, which we think is an accretive thing for them to do with their capital. The other thing that they're doing is they're generating lots of cash flow, in fact, more cash flow than earnings at the moment.
Tech companies seem to be doing very well here. I mean, Carol and I sit and watch them beat expectations every day, not just this quarter, but throughout the whole year, and also beating on the top line this quarter. Are you happy with the sector in general? I know you guys like it.
Well, in the case of technology, we were totally out of technology in the late 1990s. So for us, we start with an eye on not losing capital, and the valuations were obviously very high back then. We made some technology investments at the end of last year because the valuations came down to much lower levels. In addition to that, the companies that we've invested in have very strong balance sheets and prudent management behavior. And that's really what we look for in any investment at First Eagle.
Matt, just got a few seconds before we have to take a break. But, I mean, you do still see a lot of other opportunities in other tech names beyond Microsoft.
Well, we have owned the space more broadly. And I would say that our investments, though, have been quite selective within that, the general space. We have typically planted what I would refer to as seed positions in the technology space. This is an area where there's a lot of product change over time, and we tend to take a cautious approach. Where we've invested is where we've found valuation opportunity, and we've seen some pretty big moves, as you said, and so that's meant that we haven't really bought a lot more recently.